Welcome to Hardly. The book is distilled into 3 stories, giving you the key ideas in minutes. Today, we study together Howard Marks' The Most Important Thing, Uncommon Sense for the Thoughtful Investor, in which we probe into the significance of second-level thinking in decision-making, recognizing and managing risks in volatile markets, the importance of understanding value versus price in investments. Howard Marks, the chairman and co-founder of Oak Capital Management Company, Limited. Don't go away. Hurdley, the editor, will be right back with the story. Let me take you through 3 distinct stories that encapsulate the essence of second-level thinking, risk recognition, and understanding value versus price. Each story carries a unique lesson about the complex nature of investing, where insight and patience are rewarded. In the 1970s, the oil crisis hit global markets hard. Many investors, panicking at the rapid inflation and plunging stock prices, decided to abandon ship. One such investor, James, sold all his shares, thinking the market was doomed. However, a friend of his, Mike, who had been through similar market crashes, held a different view. Mike wasn't relying on first-level thinking, which led others to sell based on fear. Instead, he employed second-level thinking, pondering the deeper dynamics of the market. He asked himself, if everyone is selling, is this perhaps the perfect time to buy? His analysis went beyond the surface. Mike knew that market swings, like pendulums, eventually return to equilibrium. He started buying shares at rock-bottom prices, patiently waiting for the market to recover, which it did. Mike's second-level thinking rewarded him with substantial returns. The lesson here is to think beyond the obvious, to analyze not just what is happening, but why it's happening and how others are reacting to it. As Marks mentions in the book, to outperform, your thinking has to be different and better. The key to success in investing lies in going against the grain and seeking out opportunities when others only see risks. As Mike's gains grew, the story transitions to Sarah, an experienced investor who learned to master risk awareness. She had been through her share of market crashes and, in one particular case, had invested in a promising tech startup during the dot-com bubble. At first, the company seemed unstoppable. Its stock price skyrocketed and everyone was buying. But Sarah had a gut feeling that something was off. She understood that rapid market growth often leads to bubbles, and bubbles burst. Even though the company was promising, the stock price had detached from reality. She remembered that risk is not just about the potential loss, but also about the uncertainty that surrounds an investment. Knowing when to cut her losses, Sarah sold her shares just as the company's stock began to decline. Her ability to recognize risk, even when everything appeared to be going well, saved her from devastating losses. This story teaches us the critical importance of risk recognition. As the book wisely notes, risk means more things can happen than will happen. Sarah's understanding of risk saved her from a dangerous outcome that could have easily wiped out her profits. Managing risk is about anticipating potential downfalls and making decisions based on that awareness, not on temporary market highs. Sarah's experience with risk recognition leads us into the final story, where David, a seasoned value investor, learned firsthand the importance of understanding the relationship between value and price. David had his eyes set on a company that seemed undervalued. It had solid fundamentals, and the market had largely overlooked its potential. He calculated its intrinsic value and realized the stock was trading at a significant discount. But as David watched the price fluctuate, he was tempted to sell as soon as he saw a minor profit. However, he remembered the lesson from the book. Investment success doesn't come from buying good things, but rather from buying things well. He resisted the urge to cash out early and continued to hold on to the stock, trusting in its underlying value. Over time, as the market corrected its mispricing, the stock soared, providing David with the substantial returns he had anticipated. David's patience highlights the importance of not just recognizing a good company, but understanding when to buy it at the right price. It's a subtle yet crucial difference that can make or break a successful investment. Investing, as this book constantly reminds us, is not just about chasing trends, but buying valuable assets when they are mispriced by the market. Each of these stories, James with his second-level thinking, Sarah with her risk management, and David with his patience in understanding value, shows us that successful investing is about going beyond the surface, embracing uncertainty, and trusting in long-term value. These lessons work together to form a comprehensive understanding of the investing process. You must think differently, manage risks intelligently, and understand the true worth of what you're buying. As the editor of Hardly, by learning these stories, we can approach future investments with a more critical eye, moving away from short-term gains and focusing on long-term growth strategies that minimize risk while maximizing value. Each story comes from the most representative real-life cases selected by the Hardly team from this book. Beyond these 3 stories, there are 15 more equally compelling cases worth reading. If you wish to dive deeper, we recommend purchasing the full book. Finally, share a sentence from the book to end today's reading. The biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. In revisiting the key points from earlier, we see that second-level thinking, risk awareness, and understanding value versus price are not just abstract concepts, but essential pillars of successful investing. These principles guide us to look deeper, manage uncertainty, and seize opportunities when the market misjudges value. Consider the story of Tom, a hedge fund manager in the early 2000s. He noticed that most investors were blindly pouring money into tech stocks during the bubble. However, Tom had been carefully analyzing not just the company's growth potential, but their intrinsic value, and realized that many were grossly overvalued. Rather than joining the frenzy, he began shorting these stocks, essentially betting that their prices would fall. As the market reached its tipping point, the tech bubble burst, and while many investors lost millions, Tom's fund thrived. His ability to combine second-level thinking with a keen sense of risk and value turned what seemed like a risky contrarian move into one of his greatest successes. Tom's experience reinforces that thriving in the investing world isn't about following the crowd, but about thinking differently, managing risk wisely, and always having a strong grasp of value. These key lessons, drawn from both triumphs and failures, serve as a guide for navigating the complexities of investment. Armed with these insights, we are better equipped to face the challenges ahead.